If you're turning 50, let me tell you something nobody else will. Your investment strategy just changed dramatically. And if you don't adjust, you're going to spend your retirement years learning expensive lessons you can no longer afford. At 50, you don't have 40 years to recover from mistakes. You don't have time to ride out multiple market crashes. You can't afford to lose half your capital chasing returns you don't need. The game has changed, and if you're still playing like you're 30, you're going to lose. I'm going to show you how to earn 7 to 10% annually while protecting your capital. Not through speculation, not through risk-taking, through intelligent defensive investing that lets you sleep at night. This isn't about getting rich quickly. At 50, that ship has sailed. This is about staying rich, growing your wealth steadily, and reaching retirement with enough capital to maintain your independence for the next 30 or 40 years. Most people spend their 30s and 40s chasing returns. They take risks they don't understand because they think time is on their side. Then they hit 50 and realize they're running out of runway. So they panic. They either become too aggressive, trying to make up for lost time, or too conservative, stuffing everything into bonds that can't keep pace with inflation. Both approaches fail. Aggression at 50 leads to catastrophe. Extreme conservatism leads to poverty in your 80s. What you need is a third way, a strategy that protects your downside while capturing reasonable returns. A portfolio built for defense first, offense second. An approach that recognizes you're no longer building wealth from scratch. You're preserving wealth you've already built, while allowing it to compound quietly. I learned these principles during the Great Depression and refined them over decades of watching markets destroy the unprepared. What I'm about to share isn't theory. It's survival wisdom, forged in the hardest school there is. Real losses, real consequences, real fear. At 50, every decision matters more than it did at 30. Every mistake costs you years you don't have. Every moment of foolishness compounds against you instead of for you. So if you're willing to listen, I'll show you how to protect what you have, earn what you need, and sleep well regardless of what the market does tomorrow. But first, you need to accept an uncomfortable truth about your situation. Let's start with the mathematics nobody wants to face. If you're 50 with £200,000 saved and you need £500,000 to retire comfortably at 65, you need to earn roughly 6.5% annually just to reach that goal. Not spectacular, but achievable. But here's what most people miss. You can't afford to lose. If you lose 30% in a market crash when you're 30, you have decades to recover. If you lose 30% at 55, you might never get it back before retirement. This is the tyranny of limited time. Every year that passes reduces your margin for error. Every mistake becomes more expensive. Every act of stupidity becomes harder to overcome. At 30, aggressive investing makes sense. You have time to ride out crashes, to recover from mistakes, to let compounding work its slow magic. At 50, aggression is suicide. You need defense first, return second. Let me show you what a single catastrophic loss does to your retirement plans. Let's say you have £300,000 at 50. You invest aggressively, chasing 15% returns. The market crashes, you lose 40%, and you're down to £180,000. Even if you then earn 10% annually for the next 15 years, you'll only have £753,000 at 65. Now compare that to someone who invested defensively, earned only 8% annually with no major losses. They'd have £952,000. Same starting point, same time horizon, but £200,000 difference because they avoided the catastrophic loss. This is what people don't understand. At 50, avoiding disaster is more important than chasing returns. A conservative 7% with protection is worth more than an aggressive 12% with risk. The mathematics are brutal but clear. You cannot afford to blow up, not even once. Because starting over at 55 means you're starting over with a decade less time, and probably with a broken spirit. I watched this pattern destroy people during my lifetime. Men in their 50s who thought they could recover from losses like they did in their 30s. They couldn't. The arithmetic wouldn't allow it. And they spent their final working years desperately trying to make up ground they never recovered. Here's another uncomfortable truth. If you haven't saved much by 50, you have a problem no investment strategy can fully solve. If you're 50 with £50,000 saved and you need £500,000 to retire, even earning 10% annually gets you only to £210,000 by 65. The gap is too large for returns to bridge. That doesn't mean give up, it means adjust expectations. It might mean working longer, spending less, or accepting a more modest retirement. But what it absolutely means is that you cannot afford to gamble. The last thing you need is to turn £50,000 into £25,000 chasing miracle returns. At 50, the goal isn't maximum returns. It's maximum probability of reaching your retirement number without catastrophic losses along the way. That requires a different mindset than you've had for the past 2 decades. You need to think like a general protecting supply lines, not a gambler chasing the next big win. You need redundancy, not brilliance. Safety margins, not razor-thin bets. Boring reliability, not exciting speculation. This is what defensive investing means. Not timid, not fearful, but prudent, rational, focused on not losing, rather than on winning spectacularly. The younger you are, the more you can afford to be aggressive. The older you get, the more you need to be defensive. At 50, you've crossed the line where defense matters more than offense. If you accept this reality, everything else I'm about to tell you will make sense. If you reject it, if you still think you can invest like you're 30, you're going to learn this lesson the expensive way. And at 50, expensive lessons are lessons you cannot afford. Building a portfolio that survives. Defensive investing at 50 rests on 4 non-negotiable principles. Violate any of them, and you're no longer investing defensively. You're gambling with money you can't afford to lose. Pillar 1. Margin of safety. This is the cornerstone of everything I've ever taught. Never pay full price for anything. Always demand a discount to intrinsic value. Always leave room for error. At 50, this matters more than ever. When you were younger, overpaying for a good business might have cost you some returns, but not your future. At 50, overpaying can mean buying right before a crash and watching your retirement fund evaporate. Margin of safety means buying businesses trading below their intrinsic value. It means demanding that a £10 business trade at £7 before you buy. That £3 cushion protects you when your analysis is wrong, when the market crashes, when unexpected events occur. Most people do the opposite. They buy whatever is popular, whatever has momentum, whatever everyone else is buying. Then they wonder why they lose money when sentiment changes. At 50, you can't afford fashion. You need value. Boring, unfashionable, overlooked value. Pillar 2. Quality over growth. When you're young, you can afford to bet on growth companies that might quintuple or go to zero. At 50, you need companies that will still be here in 20 years, paying dividends, generating cash, surviving whatever the economy throws at them. Quality means businesses with durable competitive advantages, consistent profitability across cycles, low debt levels, management that returns cash to shareholders, products or services people need, not want. Think consumer staples, not technology. Think utilities, not startups. Think boring companies that have been around for decades and will be around for decades more. I built my fortune buying quality businesses when they were temporarily unloved. Coca-Cola, American Express. Companies that weren't exciting but were permanent fixtures of economic life. At 50, excitement is your enemy. Permanence is your friend. Pillar 3. Diversification. As insurance. I've always believed that diversification is protection against ignorance. But at 50, diversification serves another purpose. It's insurance against catastrophe. You should own businesses across different sectors, different geographies, different economic sensitivities. Not because you don't understand what you own, but because you understand that even great businesses can stumble. If you're 50 with £200,000, putting it all in one sector, even a defensive sector, is reckless. Spread it across 10 to 15 quality businesses. Yes, your best ideas will be diluted, but your worst mistakes won't destroy you. This isn't about owning 50 mediocre businesses. It's about owning 10 to 15 great businesses so that if 2 or 3 disappoint, you're still fine. At 30, concentration can accelerate wealth. At 50, Diversification protects it. Pillar 4. Income over appreciation. When you're young, you want growth. You want your £1,000 to become £10,000. You don't care about dividends because you're not spending them anyway. At 50, income matters. You want businesses that pay you while you wait. Dividends that arrive quarterly regardless of what the market does. Cash flow you can reinvest or eventually spend. A portfolio yielding 3 to 4% in dividends while growing 4 to 6% in value gives you your 7 to 10% total return. More importantly, it gives you something tangible. When markets crash and your £200,000 looks like £160,000 on paper, those dividend checks still arrive. They remind you that the businesses haven't stopped working just because the market is panicking. Warren and I always loved businesses that paid us to own them. Dividends force management discipline. They return cash to owners, and they smooth out the emotional roller coaster of market volatility. At 50, you need that emotional stability. You need to see tangible returns, not just numbers on a screen that fluctuate wildly. Putting it together. These 4 pillars work together. You buy quality businesses, Pillar 2, at prices below intrinsic value, Pillar 1, spread across multiple holdings, Pillar 3, that pay you reliable dividends, Pillar 4. This isn't exciting, it won't make you rich quickly, but it will get you to retirement with your capital intact and growing steadily. The younger generation chases meme stocks and cryptocurrencies. Let them. You're playing a different game now. You're not trying to get rich. You're trying to stay rich and get a little richer each year without taking catastrophic risks. These 4 pillars have protected wealth through the Great Depression, multiple recessions, the dot-com crash, the 2008 financial crisis, and every other market convulsion of the past century. They work. They're boring. And at 50, boring is exactly what you need. Building the defensive portfolio. Now let's get specific. What does a defensive portfolio for a 50-year-old actually look like? What to buy? Consumer staples. These are businesses that sell products people need regardless of economic conditions. Food, beverages, household products, personal care items. Companies like Unilever, Procter & Gamble, Nestlé. They're not exciting. They won't double in a year, but they won't collapse either. They pay reliable dividends. They survive recessions. They compound steadily. At 50, boring consumer staples should form the core of your portfolio. 25 to 30% allocated here gives you stability and income. Utilities. People need electricity, water, and gas in good times and bad. Utilities are regulated monopolies with predictable cash flows and dividend policies. National Grid, SSE, United Utilities in the UK. These companies won't make you rich, but they won't make you poor either. They're the financial equivalent of a comfortable, reliable car. Not sexy, but it gets you where you need to go. Another 15 to 20% here provides ballast to your portfolio. Healthcare. Demographics are your friend. Aging populations need more healthcare, not less. Pharmaceutical companies with proven drugs. Medical device makers with essential products. Healthcare service providers with steady demand. GSK, AstraZeneca, Johnson & Johnson. Companies with products that people literally cannot live without. 15 to 20% allocated to healthcare gives you both growth and defense. Financial services, selectively. Not investment banks or speculative lenders, but well-run insurance companies. Boring high street banks with conservative lending practices. Payment processors with moat-protected franchises. Companies that profit from the basic infrastructure of capitalism without taking idiotic risks. 10 to 15% here, carefully selected, adds to your income stream. Dividend aristocrats. These are companies that have raised dividends every year for 25 years or more. They're not all in defensive sectors, but their track record proves management discipline and business durability. At 50, these should be your hunting ground. Companies that have navigated multiple recessions and kept paying and growing dividends are companies you want to own. What to avoid? Technology. I know this is controversial. Everyone loves technology. It's the future. But here's the problem. At 50, you don't need the future. You need the present, delivered reliably for the next 20 years. Technology companies are often overvalued. They're disrupted constantly. Today's leader is tomorrow's has been. and they rarely pay meaningful dividends. Can some older investors own some technology? Perhaps, but it shouldn't be the core of your portfolio. And you certainly shouldn't own technology you don't understand just because it's fashionable. Small cap growth. These are companies with massive potential but also massive risk. They might become the next Amazon. They might also go to zero. At 30, bet on a few. At 50, avoid them entirely. You don't have time to wait for long-shot bets to pay off, and you can't afford the losses when they don't. Bonds, with caution. Everyone tells 50-year-olds to buy bonds. I'm more skeptical. In a low-interest environment, bonds offer little return. In a rising rate environment, they lose principal value. I'd rather own quality dividend-paying stocks that can grow earnings and raise dividends over time. Stocks with 3% yields that grow 5% annually are better than bonds paying 4% that can't grow at all. That said, some bond allocation for true emergencies makes sense, perhaps 10 to 20% in short-duration government bonds as genuine insurance. But don't make bonds the core of your portfolio. Unless you're already wealthy enough that you don't need returns, you just need preservation. Cryptocurrencies, meme stocks, options, leverage. If you're 50 and putting serious money into any of these, you've learned nothing from life. These are speculations, not investments. They're gambling, not wealth building. Let the 25-year-olds play these games. You have too much to lose and too little time to recover. A sample portfolio. Here's what a defensive 200,000-pound portfolio might look like for someone at 50. 60,000 pounds, 30%. Consumer staples, 4 to 5 quality companies. 40,000 pounds, 20%. Utilities, 3 to 4 regulated monopolies. 40,000 pounds, 20%. Healthcare, 3 to 4 pharmaceutical device companies. 30,000 pounds, 15%. Financial services, 2 to 3 conservative banks, cheap insurers. 20,000 pounds, 10%. High-quality bonds or cash for emergencies. 10,000 pounds, 5%. Other dividend aristocrats. Total holdings, 12 to 16 businesses. Expected yield, 3 to 4%. Expected total return, 7 to 10% annually. Boring? Absolutely. Safe? Relatively? Effective? History says yes. This won't make you rich overnight, but it will get you to retirement without catastrophic losses. And at 50, that's victory. The catastrophes that destroy 50-year-olds. Let me tell you about the specific ways people in their 50s destroy themselves financially. I've watched these patterns repeat for decades. Disaster 1, panic selling. During crashes, markets will crash before you retire. Guaranteed, your 200,000 pounds will become 140,000 pounds on paper. Every news outlet will scream that the world is ending. Your friends will tell you they sold everything. Don't join them. If you've built a defensive portfolio of quality businesses, the crash is irrelevant to your long-term outcome. The companies are still operating. They're still paying dividends. The only thing that's changed is the price Mr. Market is quoting you today. But here's what kills 50-year-olds. They look at their account, see they've lost 60,000 pounds, and panic. They sell everything to preserve what's left. Then they watch from the sidelines as the market recovers, and they never get back in. They've converted a temporary paper loss into a permanent real loss, and they've missed the recovery that always follows the crash. I lived through crashes that made 2008 look mild. Every single time, the people who sold at the bottom regretted it. Every single time, the people who held or bought more prospered. At 50, you need the emotional discipline to do nothing during crashes. That's harder than it sounds, but it's essential. Disaster 2, chasing yield into dangerous territory. When you're 50 and you hear about a company paying 8% dividends, you get excited. Finally, real income. But high yields are often high for a reason. The market is pricing in dividend cuts, business deterioration, or outright bankruptcy. I've seen people in their 50s chase high-yield traps and watch those dividends disappear just when they needed them most. You're better off with a boring 3% yield that's safe than an exciting 8% yield that's about to become 0%. Quality first, yield second. Always. Disaster 3, trying to make up for lost time. This is the most common and most destructive mistake 50-year-olds make. They look at their savings, realize they're behind where they should be, and decide they need to take bigger risks to catch up. They chase higher returns. They use leverage. They bet on speculative investments. It almost never works. What usually happens is they turn a bad situation into a catastrophic one. If you're behind at 50, the answer isn't more risk. It's more savings, longer working years, and lower retirement spending. Those are painful truths, but they're better than gambling with money you can't afford to lose. Disaster 4. Concentration in your employer's stock. Many people in their 50s have accumulated significant holdings in their employer's stock through options, employee purchase plans, or simple loyalty. This is dangerous for two reasons. First, your income and your investment portfolio are both tied to the same company. If something goes wrong, you lose your job and your savings simultaneously. Second, employer stock is rarely bought with the same critical analysis you'd apply to other investments. It's bought out of loyalty, not logic. At 50, you should be diversifying out of employer stock, not accumulating more. I don't care how great you think your company is. Diversify anyway. Disaster 5. Lifestyle inflation as income rises. Your 50s are often your peak earning years. You get promotions, raises, bonuses. Your mortgage might be paid off. Finally, you have cash flow. And that's when most people increase their spending to match their income. Nicer car, bigger house, expensive holidays. They tell themselves they've earned it. They have earned it. But spending it now means not having it in retirement. Every pound spent in your 50s is a pound that can't compound for your 60s and beyond. The intelligent 50-year-old does the opposite. As income rises, savings should accelerate. This is your last chance to build capital before retirement. Don't waste it on consumption. You'll forget in a year. Disaster 6. Believing past returns predict future ones. Just because markets returned 15% annually for the past decade doesn't mean they'll do it for the next. Mean reversion is real. High valuations today often lead to low returns tomorrow. At 50, plan conservatively. Assume 7 to 8% returns, not 12 to 15%. Hope for better, but don't need better. That's how you avoid disappointment and financial distress. Avoiding these 6 disasters won't make you rich, but it will prevent you from becoming poor. And at 50, that's the priority. Mastering your mind in the dangerous decade. Your 50s are psychologically treacherous. You're old enough to know better, but young enough to still take foolish risks. You're close enough to retirement to taste it, but far enough that it feels abstract. This combination creates unique psychological vulnerabilities. The comparison trap. At 50, you start measuring yourself against peers. Your university friend retired at 48. Your colleague just bought a holiday home in Spain. Your neighbor drives a Tesla. Meanwhile, you're still working, still saving, still worrying about retirement. This is poison. Comparison at 50 leads to one of two disasters: reckless risk-taking to catch up, or depression that paralyzes you into inaction. The truth is, you have no idea about other people's financial reality. Your friend who retired at 48 might be living on unsustainable drawdowns. Your colleague's holiday home might be mortgaged to the hilt. Your neighbor's Tesla might be leased with money he can't afford. Focus on your own numbers, your own goals, your own progress. That's all that matters. The regret spiral. 50 is when regret hits hardest. You think about the Apple shares you didn't buy, the house you didn't purchase, the career change you didn't make. This regret makes people do stupid things. They try to make up for past mistakes with present risks. They convince themselves they're owed a lucky break after years of playing it safe. You're not owed anything. The market doesn't care about your regrets. It only cares about your decisions today. Let go of past mistakes. You can't change them. Focus on not making new ones. The immortality delusion. In your 20s and 30s, retirement feels impossibly far away. In your 50s, you suddenly realize it's approaching fast. But human psychology is strange. We still act like we have unlimited time. We take risks we shouldn't because we think we can recover. We delay decisions we should make because there's still time. We avoid facing uncomfortable realities because acknowledging them is painful. At 50, you need to face reality squarely. How much have you saved? How much do you need? What's the gap? How will you close it? These aren't pleasant conversations, but they're necessary. Denial at 50 becomes disaster at 65. The fear-greed pendulum. Most 50-year-olds swing between two extremes. When markets are up, they feel behind and get greedy. They chase returns to catch up. When markets crash, they get terrified and sell everything. Both reactions are wrong. Both destroy wealth. You need to develop what I call rational equanimity. The ability to watch markets rise without greed and fall without fear. To make decisions based on value, not emotion. To stay invested in quality businesses regardless of what Mr. Market is offering you today. This is harder at 50 than at 30 because the stakes are higher. Every decision feels more important because it is. But that's exactly why emotional discipline matters more. The validation trap. At 50, many people need external validation that they're doing it right. So they ask friends for stock tips, follow financial gurus on social media, watch CNBC for reassurance. This is how you end up making other people's mistakes instead of your own. At 50, you should have enough life experience to trust your own judgment. If you followed the principles I've laid out, quality, value, diversification, income, you don't need validation from talking heads who have no stake in your financial future. The control illusion. 50-year-olds often feel they should have everything figured out by now. So when markets behave irrationally or investments disappoint, they blame themselves. They think they did something wrong, that they missed some signal, that they're not smart enough. Most of the time, that's not true. Markets are unpredictable. Even great businesses stumble occasionally. You can't control outcomes, only behavior. Accept that uncertainty never goes away. The best investors aren't the ones who are always right. They're the ones who survive being wrong. Building psychological resilience. How do you master this psychological minefield? First, have a written investment plan. When emotions surge, the plan keeps you grounded. Second, measure progress annually, not daily. Stop checking your portfolio every morning. It creates emotional volatility without adding information. Third, maintain perspective. A 20% market drop when you're 50 with 200,000 pounds means you're temporarily down 40,000 pounds. But if you're in quality businesses, that loss is only realized if you sell. If you hold, history says you'll recover. Fourth, separate your self-worth from your net worth. You are not your portfolio balance. You're a human being with value beyond money. At 50, the battle isn't in the market. It's in the mirror. Master yourself, and the investing becomes easy. A 15-year plan to retirement. Let's build a practical roadmap from 50 to 65, assuming you're starting with 200,000 pounds and targeting 500,000 pounds for retirement. Years 50 to 55, the accumulation sprint. These are your highest earning years. Maximize them. If you earn 60,000 pounds annually and can save 20%, 12,000 pounds per year, and your existing 200,000 pounds grows at 8% annually, you'll have roughly 420,000 pounds by 55. This is the sprint phase. You're still working full capacity. Your expenses might be dropping as children become independent. Your mortgage might be paid off. Every pound saved now has 15 years to compound before retirement. That's powerful. A 12,000-pound contribution at 50 becomes 38,000 pounds by 65 at 8% growth. Don't ease up now. This is your last chance to build serious capital. Portfolio allocation. At 50 to 55, 70% equities, defensive quality businesses. 20% bonds, 10% cash. You can still handle some volatility, but you're moving toward defense. Years 55 to 60, the transition. By 55, you should have roughly 420,000 pounds if you followed the plan. Now the goal shifts slightly. Continue saving perhaps 10,000 pounds annually, but start thinking about de-risking. Not drastically, but gradually. You're 10 years from retirement. Major market crashes still won't destroy you, but they're becoming more consequential. If your 420,000 pounds grows at 7% and you add 10,000 pounds annually, you'll reach 670,000 pounds by 60. Portfolio allocation. At 55 to 60, 60% equities, increasingly defensive, 30% bonds, 10% cash. You're prioritizing capital preservation while still allowing growth. Years 60 to 65, the protection phase. By 60, you should have roughly £670,000. Now it's all about getting safely to the finish line. You might still be saving, but possibly less as you consider semi-retirement or reduced hours. Let's assume £5,000 annually. If your £670,000 grows at 6% and you add £5,000 annually, you'll reach £924,000 by 65. That's nearly double your original £500,000 target. The cushion matters because you've overestimated nothing. You can weather market downturns in early retirement. You have margin for unexpected expenses. Portfolio allocation. At 60 to 65, 50% equities, rock-solid dividend payers. 40% bonds, 10% cash. Protection now outweighs growth. You're preserving what you've built. What if you're behind? Not everyone reaches 50 with £200,000. What if you have £100,000? Or £50,000? The mathematics are brutally clear. Starting with £100,000 at 50, even saving £12,000 annually, and earning 8% gets you to only £520,000 by 65. It's enough to retire, but modestly. Starting with £50,000, the same inputs get you to only £370,000. That's not enough for most people's retirement needs. If you're significantly behind, you have three options. Option 1, save more. Can you save £15,000 or £20,000 annually instead of £12,000? Every additional pound helps, but the mathematics are unforgiving. You can't save your way out of a massive shortfall in 15 years. Option 2, work longer. Every year you delay retirement has multiple benefits. More time to save, more time for investments to compound, shorter retirement period to fund, delayed state pension increases payments. Working until 70 instead of 65 can make a £200,000 difference in your financial security. Option 3, adjust expectations. Perhaps you don't need £500,000. Perhaps you can live on less. Perhaps you'll downsize your home, move to a lower-cost area, or maintain a part-time income in retirement. These aren't failures. They're adaptations to reality. The safety margin principle. Whatever your target, build in a 25% safety margin. If you think you need £400,000, target £500,000. If your calculations say £600,000, aim for £750,000. Why? Because you'll underestimate healthcare costs, inflation, longevity, or unexpected expenses. Everyone does. The people who retire comfortably aren't the ones who hit their number exactly. They're the ones who exceeded it by enough to handle life's inevitable surprises. At 50, you're 15 years from retirement. That's enough time if you act now. It's not enough time if you keep procrastinating. Make the plan. Follow the plan. Adjust the plan when necessary. But don't ignore the plan. What will try to destroy your wealth? Between 50 and retirement, your capital faces specific threats. Understanding them means you can defend against them. Threat 1. Inflation. This is the silent killer of retirement savings. At 3% annual inflation, your money loses half its purchasing power in 24 years. If you retire at 65 with £500,000, by the time you're 85, that money buys what £275,000 buys today. If you live to 95, it's down to £150,000 in purchasing power. This is why you can't just hide in bonds or cash. You need assets that grow, equities in quality businesses that can raise prices and increase dividends over time. Even in your 50s and 60s, you need inflation protection. That means staying invested in real businesses, not retreating entirely into fixed income securities. Threat 2. Sequence of returns risk. This is the nightmare scenario. Markets crash right as you retire. Imagine you retire at 65 with £500,000. You plan to withdraw £25,000 annually, 5%. In year 1, markets drop 30%. Your portfolio falls to £350,000. You withdraw £25,000, and you're down to £325,000. Now you need your remaining capital to recover and support you for potentially 30 more years. That's much harder from a reduced base. This is why the 5 years before and after retirement are critical. Major losses during this period can permanently impair your financial security. The defense is gradual de-risking as you approach retirement and maintaining enough bonds or cash to cover several years of expenses without having to sell equities during downturns. Threat 3. Healthcare costs. Everyone underestimates this. The NHS provides coverage, but private treatments, medications, care homes, these costs accelerate as you age. A care home in the UK can cost £40,000 to £60,000 annually. If you or your spouse need care for several years, it can consume £200,000 or more. You can't avoid this threat entirely, but you can prepare for it. Long-term care insurance, health savings, and maintaining a larger capital base than you think you need all help. Threat 4. Longevity. People routinely underestimate how long they'll live. A healthy 65-year-old couple has a good chance one of them will live to 95. That's 30 years of retirement to fund. If your calculations assume you'll only live to 85, you might run out of money in your 90s when you're least able to fix the problem. Plan for living to 95. If you die sooner, you leave more to heirs. If you live that long, you're protected. Threat 5. Family financial drains. At 50, financial pressure often comes from both directions. Adult children need help with deposits, education, or unexpected crises. Aging parents need care or financial support. Your instinct is to help, but every pound given away is a pound that can't compound for your retirement. You need to draw hard lines. Help where genuinely essential, but not to the point of jeopardizing your own future. You can't pour from an empty cup. Threat 6. Cognitive decline. As you age, your mental sharpness may decline. This makes you vulnerable to bad financial decisions, fraud, or simply forgetting to manage your affairs properly. The defense is simplification. By 60, your portfolio should be simple enough that managing it requires minimal cognitive load. Automated investments, clear systems, and trusted advisors who can help if needed. Complexity is the enemy of elderly investors. Simple, boring, defensive portfolios are easy to maintain, even as mental acuity fades. Threat 7. Divorce. Divorce rates among those over 50 have risen dramatically. Gray divorce, they call it, and it's financially catastrophic. Splitting assets in your 50s means both parties have less capital to compound and less time to rebuild. Legal fees, establishing separate households, dividing pensions, it can cut your retirement resources in half. Right when you can least afford it. I can't tell you how to save your marriage, but I can tell you that protecting your financial future at 50 includes honest conversations with your spouse about retirement goals, spending habits, and long-term plans. Building defenses. Against these threats, you need diversified assets that can grow with inflation, gradual de-risking as retirement approaches, larger capital cushions than you think necessary, simplified systems you can maintain as you age, clear boundaries with family financial requests, legal protections, wills, powers of attorney, trusts. You can't eliminate all threats, but you can build redundancy so that when threats materialize, and they will, you survive them. At 50, hope is not a strategy. Defense is the discipline of selling. Everyone talks about what to buy. Almost nobody talks about when to sell. At 50, this matters enormously because bad sells cost you years of compounding you can't recover. When you should sell. Reason 1. Fundamentals deteriorate. If the business reason you bought a company changes fundamentally, sell. Management becomes incompetent or corrupt. The competitive advantage erodes. The business model breaks. Debt levels become dangerous. These are legitimate reasons to exit. But be honest with yourself. Is the fundamental thesis actually broken? Or are you just uncomfortable because the stock price dropped? These are very different situations. Reason 2. Extreme overvaluation. If a stock in your portfolio becomes absurdly overvalued, trading at prices that assume perfection for decades, taking some profits makes sense. I'm not talking about a stock that's up 50%. I'm talking about valuations that are detached from any reasonable expectation of business performance. Even then, I'd sell partially, not entirely. Maybe trim a position from 10% of your portfolio to 5%. Take some chips off the table, but don't abandon quality businesses just because they're temporarily expensive. Reason 3. Rebalancing toward retirement. As you move from 50 to 65, gradually shifting from 70% equities to 50% is prudent. This means selling some equities and buying bonds or holding cash. Do this gradually, not all at once. Perhaps reduce equity allocation by 2% annually. That way, you're not trying to time the market, just systematically de-risking as retirement approaches. When you should never sell? Reason 1, the price dropped. This is the most common mistake. The stock you bought at £50 is now £35, so you sell to stop the bleeding. If you bought it correctly, at a discount to intrinsic value with a margin of safety, then £35 is likely an even better bargain than £50 was. You should be buying more, not selling. Panic selling turns temporary paper losses into permanent real losses. Don't do it. Reason 2, you're bored. At 50, boredom is a feature, not a bug. If your portfolio is boring, that means it's working. Boring companies paying boring dividends, creating boring wealth. The itch to do something, to trade, to refresh the portfolio, to chase excitement is your enemy. Resist it. Reason 3, something else looks better. This is called the grass is greener fallacy. You own Company A, Company B looks more attractive. So you sell A to buy B. The problem is you're usually wrong about B being better. And you've created taxable events, trading costs, and opportunity cost by abandoning a perfectly good investment. Unless Company A is fundamentally broken, hold it. You can buy Company B with new capital if you have it, but don't churn your portfolio chasing marginally better opportunities. Reason 4, you've made a profit. People love to take profits. They buy a stock at £50, it goes to £70, and they sell feeling clever. But if you bought a quality business at a reasonable price, why would you sell it just because it went up? If anything, its rise validates your thesis. The business is performing. Mr. Market is recognizing value. Taking profits for the sake of taking profits is a guaranteed way to underperform. You'll be out of your best businesses and stuck with your worst ones. The hold forever mentality. Warren and I prefer to hold forever, not because we're lazy, but because selling great businesses is usually a mistake. The best businesses compound for decades. Every time you sell, you interrupt that compounding. You create taxes. You risk not finding anything equally good to buy. At 50, your default should be hold. Only sell when you have a compelling fundamental reason. Most of the time, doing nothing is the right answer. At 50, you should have learned this by now. If you haven't, you're going to spend the next 15 years learning it the expensive way. I've spent this time telling you what you can't do, what you must avoid, what threatens you. Let me end with what you have that younger investors don't. Clarity. At 50, you know yourself. You've lived through market crashes. You've made mistakes. You've learned, hopefully, what works and what doesn't. You know you're not going to get rich quickly. You know speculation is gambling. You know that compound interest is real but slow. These insights, which took decades to earn, are your competitive advantage. The 25-year-old is still making mistakes you've already made. The 35-year-old is still chasing returns you've learned to ignore. The 45-year-old is still distracted by noise you've learned to tune out. At 50, you can be boring and disciplined because you've finally learned that boring and disciplined wins. The younger generation still needs to learn this lesson. You already have. Use that wisdom. Build a defensive portfolio of quality businesses bought at reasonable prices. Collect your dividends. Ignore the market noise. Add capital when you can. Avoid catastrophic mistakes. Do this from 50 to 65, and you'll retire with enough capital to maintain your independence for the rest of your life. Not because you were brilliant, but because you were prudent. Here's what nobody tells 50-year-olds. You're not behind. You're exactly where you need to be if you act now. 15 years is enough time. Not enough to waste, but enough to win if you're disciplined. The people who fail financially in their 50s fail because they either panic or they gamble. They abandon quality for promises of quick returns. They sell during crashes. They chase fads. They confuse activity with progress. Don't be them. You're smarter than that. You've earned that wisdom through experience. The strategy I've given you works. It's not exciting. It won't make cocktail party conversation. Your neighbor won't be impressed. But 15 years from now, you'll retire comfortably while others keep working because they never learned what you finally understand. Defense matters more than offense once you're past 45. Protecting capital isn't cowardice, it's wisdom. Earning 7 to 10% safely isn't settling, it's succeeding. Living below your means isn't sacrifice, it's strategy. At 30, you can afford to be aggressive. At 50, aggression is suicide. But defense, properly executed, gets you everything you need. You have 200,000 pounds, or thereabouts. You have 15 years. You have the capacity to save. You have the wisdom to be boring. That's enough. More than enough if you don't sabotage yourself. Every person who retires comfortably does so because they made good decisions consistently for a long time. They weren't geniuses. They weren't lucky. They were disciplined. You can do this. You have time. You have knowledge. You have, if you accept it, the humility to admit you're no longer building wealth. You're preserving it. The 50-year-old who accepts reality and invests defensively will retire wealthier than the 50-year-old who pretends he's still 30 and gambles with capital he can't afford to lose. So here's my final advice. Stop comparing yourself to others. Stop regretting past mistakes. Stop dreaming of quick riches. Start protecting what you have. Start earning reasonable returns safely. Start building the boring defensive portfolio that will carry you through retirement. Do this in 15 years from now. You'll thank yourself. You'll have the freedom that comes from financial independence. The peace that comes from knowing you did it right. The satisfaction of reaching the finish line intact. That's what 50-year-old investing is about. Not brilliance, not luck, just steady, defensive, intelligent wealth preservation. You know this now. The question is, will you do it?